Hello guys. Today we're going to finish our last chapter in Managerial, chapter 15. It's very short. We are looking at just doing the ratio computations for this chapter and give it a little more insight into just how we compute them. Our exam is scheduled for the 14th of next week, a week from today. However, since today is Tuesday, I'll open it up on Thursday already for those that want to take it early. So please complete the homework though by the 9th. Remember those concept clicks are also due today before midnight. So looking at hopefully the handouts, I did give you a summary page of all of our ratios that we'll cover in this chapter. It does take some time to get through them all. That's why I reserved 2 days for it. The page 1 liquidity section talks about cash flow. What position are we in for cash flow purposes? We then scroll down the page. We get to our leverage ratios. Basically, our debt to equity ratios are located here. How are we financing our asset purchases? Banks look at these ratios to determine whether or not you are over leveraged with debt or do you have the ability to take on more debt. And finally, at the end on page 2, if we flip the page over, are all the profitability ratios. The first couple, let's say 3, 4, are the ones predominantly used. The other ones are for the larger corporations who have shareholders and so forth. Obviously, those are more in tune for that type of company. But smaller companies, the first 4 are basically what we're looking at doing. The gross margin is pretty self-explanatory. So our chapter begins on page 837. The company profile is Apple, and Apple is a very successful company, and it talks about their ratios or some of their financial ratios that they have. And one of the things that I wanted to show on page 837 was Apple's profitability ratio. Its company's return on sales is 0.23. And that just shows, like it says in here, it's 23 cents of every dollar in sales is left over as profit. So a huge, large profit margin, 23%, is what they return on every sale dollar. So every dollar of sales, they basically make 23 cents. So that is a large, large margin. So that's why they're very successful, and it talks about how much cash they have. That's incredible. It's in the billions for cash reserves. So very interesting. If you get a chance, please take a look at that article. So I'd like to start with let's see, page. That first couple slides were just how it's used. But our actual discussion begins on page 838. It's the common size analysis, it's called. And we've done these ratios in other courses. We've done these in accounting too, probably intermediate as well. So this is hopefully somewhat of a review for us. And there are 2 forms of common size analysis, and that is a horizontal analysis, which is down here. That's what we'll start with today. And then our vertical analysis is another type of common size analysis technique. Again, the purpose of these is to help us analyze our operation. And when we're looking at horizontal analysis, horizontal means across years, as opposed to vertical analysis within the same year. Basically looking in both directions. How did we compare to last year? And then the vertical analysis, how are we doing this year to budget numbers? So we'll start with the horizontal analysis, and this is on page 839. It's called a trend analysis because it crosses multiple years. So we're going from period 1 to period 2 to period 3 to see how our operation is progressing year to year. We're looking at a base period. Usually it's called year 1. That's our base. And we are projecting out and seeing how we are doing compared to that base year. Hopefully the base year is a good year. And are we improving on our operation as we go into our future years? So that's what we're trying to determine here. So if you look at example 1 on page 840, they give us 3 years of numbers. And that's what's nice with this horizontal analysis. We can look back into the future, so to speak, see how we're doing. And by the numbers themselves, you can see that the sales are progressing in an upward trend, which is always a good sign. And looks like our profit is relatively the same. So something's happening as our sales are increasing, so are our expenses, obviously. So how do we get this percentage number that we are looking to do our analysis with? And it's a simple division. Our base, our denominator, is always our base year 1 amounts. So if we look at our first percentages, if we divide base by itself, it's going to be 100%. If we're looking at year 2, our sales change to 120, but remember our base year stays constant. That gives us 120% of base year. And then finally in our third sale year, 132, the base again remains at 100. That's our year 1 amount. So compared to base year 1, we're at 132% more than that particular period of time. And you go through the entire row by row. Again, base is in year 1. These are all 100% because we're just dividing by itself. If we're looking at the cost of sales, how do we get the 125? We basically take the 75,000 we had in cost of sales in year 2. We divide by the 60,000 base year in year 1. And that's how we get the 125. Teresa talks too loud. Did I get that on recording? I think I did. I talk loud too. Any questions on how we get the percentage, guys? This 125. And obviously year 3, then we would take the 81,000 divided by 60,000 to get the 135%. Guys at home, are you okay with that? Okay, thanks, Allison. Sandy? Sydney? What do you think? All right, Sandy, thank you. Oh, Cindy, awesome. You can hear me. Great. Super. All right, so let's continue and let's do an actual problem here. This is problem 39. Sydney, do you have the packet? I should have gave it to you. If not, I'm going to have to email it to you. I can't remember if I gave it to you. Sydney. Hello. Hi. Oh, must have it. I'm hoping. Anyway, problem 39 is our first attempt at this. I put the numbers in already, so if you could turn your page to page 79, you can copy those numbers down. Yep, so right here. Perfect timing.
Thanks. Did you guys just start?
No.
Okay.
It was my lecture, so.
Oh.
Yeah. Oh, this other sheet is just a summary of the ratios.
Okay, thank you.
All right, so let me jump to 879. Looks like they're very successful. Remember, this is year 2. Year 1 is also given, but remember that's our base year. So in this particular example, we have in year 2, 1.2 million, cost of sales 700,000, gross margin 500, and then minus our expenses, we get an operating income of 220, less our interest expense, which is non-operational, right? That's why it's after operating income. It's a finance expense. We get to our income before taxes of 195. So these are just copied numbers from the problem. So to get our first year percent column complete, we have to take our base year numbers. For sales, our base year 1 was $1 million. We put on year 2's amount of 1.2 million, which gives us a percentage of 120%. So that's actually our first number here, 120%. If we do our cost of sales as an example, the base year amount is how much for cost of sales? What's our bottom number here? What is year 1's total for cost of sales? 700,000. And by chance, it's the same number for year 2. So remember, we're always dividing our year 2 number, in this case, by year 1's number. So this is 1, so my percentage is 100%. Now we don't put these, even though cost of goods sold is a negative number, right? We don't put up brackets in this 100%. We leave it as a positive number. Our gross margin, our third number, our base amount is how much? What's our bottom number for year 1? That 300,000. So that is what percentage then? Should know it.
Well, 1.66 repeating.
Okay, so I'm just going to make and round it to the whole percent. Well, that wouldn't be whole percent, to the 10th position, 166.7%. And we can keep going to 20. I'm going to come over to here, divide by 150, base 1 year's amount. Allison, do you have that number for the selling expense? 220 divided by 150? I think it's is it 125? 1.46 repeating, all right. I'm just going to round that to the 10th then. Going on to admin expense, 60 divided by 50. I don't know what that is either, Eric. Do you know that?
1.2.
1.2? So that would be 120%. Operating income, 220. The base is 100. So that's obviously 2.2 or 220%. So a huge change in our operating income from base year, 220% higher than our base year. The interest expense didn't change, it remained at 25, so that again is 100%, no change. And then our actual operating income before taxes, 195 over 75. That too is 2.1, guys. 2.6, thank you, Carla, or 260%. So here again, it shows the great increase, right, over our base 1 year amounts. Thanks, Allison. It's 2.6, I hope, not 6. Okay, cool. Now, obviously, you could do the same thing with year 3. We would take again our base year, let me switch colors, 1.7 million. But we divide by our year 1 base year. We don't go to year 2. That's 1.7, or from base year 1, we'd be at 170% of base year 1. Let's just do one more here. 1 million for cost of sales. Base year, our cost of sales was 700,000. $1.4285. So 148. Oh, excuse me. 142. Round to the 0.9 position because it's 857. So it's 5 or above, so we round up to the nearest 10th position here. So hopefully that type of horizontal analysis is okay. Any thought on this computation to get the percent numbers. It's pretty straightforward, it's just that base year that we have to remember. Okay, our next computation is, there's another problem here if you want to practice. I'm going to go on to our next computational page, 840 of our book again, where we left off. Page 840, 841. We're looking at vertical analysis. And here we're within one period of time, within the year in most cases. It's a line-by-line percentage of some base number. So the base number for vertical analysis on an income statement, the base number is going to be sales dollars. On the balance sheet, if we were doing a balance sheet vertical analysis, the base is always the asset dollar amount. So depending on the income statement, and most software programs will do an automatic vertical analysis. If you ran a QuickBooks profit and loss, or you ran a Sage profit and loss statement, they would have this vertical percentage analysis on it automatically. So it talks about how do we create these, how do we get these percentages. They use example 2 as our practice for vertical analysis, giving us 3 years of analysis. And then they talk about that base year on page 840 for income statements. That's what we're looking at, the base year. In this case, they say it's net sales. So that is always going to be then our 100% amount. So now they're dividing each of these amounts by that base sale amount. Like I said, these are more common types of analysis, these vertical ones versus the horizontal, because many software programs already include them in the software. So our example for a vertical analysis then is problem 40, page 879. Already have the year 1 numbers. I think we're only going to do year 1. We're not going to do 2 and so forth. We'll just do year 1's computations. Remember, the base on an income statement is always sales. Always sales. So to get our cost of goods sold vertical percentage, we simply take the 700 and we divide by the 1 million. Obviously, that's 70%. And here again, they're going to one place, one decimal. Is one decimal place as a percent. I guess you could call it that way. 300 divided by 1 million is 30%. Okay. 150 divided by 1 million. Again, 1 million is our base. It's 15%. Nice that 1 million was used as the sale number. 50,000 to 1 million is 5%. Just dividing by the 1 million, each of these numbers. 100 is obviously 10%. 25,000 is 2.5%. And our profit, 7.5%, to wrap it up. So all I'm doing is I'm dividing each of these numbers by the $1 million base number, sales. If I were to go into part 2, for year 2, I would take each of our numbers and what we divide by the 1.2 million base number for year 2. So this is a little different than the horizontal analysis that we had earlier. We don't cross years when we're doing a vertical analysis. So 700,000 divided by 1.2 million, I've got 58.3 repeating percent. That's what this number is. I bring that up. If I do 500,000 divided by 1.2 million, I should get 42, no, 41.7, I think. That look right? 41.7?
It's still 500,000 divided by
1.2 million. Because remember our base year in year 2, that's our denominator. Is that right? Okay. So please know on this type of analysis, this vertical analysis, that each year is independent. We're not crossing years like on our horizontal analysis. Is that all right with everyone? Vertical analysis? Okay. And that's what I want to talk about next, and that's what the next slide is. Looking at just cost of sales, in year 1 it was 70%, in year 2 it was 58%. Is that a good result? I was at 70 for cost of sales, now I'm at 58. That's a very good example of a positive change, right? This, if I saw this on an income statement compared to last year's percentages, I'd be extremely happy with that jump, with that decrease in our cost of goods sold. So that's awesome. And if you notice here, our gross margin went from 30 to 41%, 11 percentage points, almost 12, a huge improvement again, but mainly because not only do we have more sales, but mainly because we have smaller or reduced costs in our numbers. So these are the type of analysis that you'll have to, inform your boss, show them that you're doing the correct things in your operation and improving the results from year to year. And bankers love that type of analysis as well. All right. So on page 841, the beauty thing about percentages is that it eliminates the effects of size. So our results here, I don't know what kind of company this is, but let's say I'm a small little restaurant and those were my percentages. I could compare my percentage restaurants numbers to McDonald's or some other bigger company. Percentages gives us or has us the ability to verify or cross-check ourselves to another competition. And a lot of companies will do this. They'll compare their results to another company's results. If I'm in shipping, I might compare my financial numbers to FedEx, who's also in shipping for delivery. And how are we compared to those larger companies who are very successful? So keep that in mind when we're doing this type of analysis. There are many reports done in Bradstreet They do this industry averages. They'll give you industry averages, all percentages for the most part. And that's a great resource to compare your operation to somebody else's in the same industry. So try to keep that, Google that, and find that information. All right, so we now jump to our ratio analysis part of chapter 15. This begins on page 842. When we get to ratios, what is a ratio? It's a fraction, right? We're dividing one number over another number to get our analysis of that particular area of our operation. And there is a small, how do I use this ratio? You can review that if you wish. I got laundry to do apparently, it must be my subconscious. For ratios, we want to always compare to something, either ourselves, right? Compared with our standard, whether it be ourselves or another company's averages or an industry average. Ratios by themselves mean very little. It's not until we compare it to something that we can analyze our operation. So here's a small graph looking at our ratios to competitors, very common practice, also industry averages, right? So here is where our template or worksheet comes into play. Like the book, I organized our ratios into liquidity, leverage, and profit. So there's a small definition of each of those classifications. And then we're going to start, though, with our liquidity. If you are going to have difficulty with your operation, most problems for small companies revolve around liquidity. And this is actually not only a small company problem, but one that is growing. Sometimes companies grow too fast and simply run out of cash, right? Is basically the difficulty here. So measuring our liquidity is so important. Some companies feel that cash liquidity is something that has to be monitored daily. So this is taken very seriously. The liquidity ratios here are the four main ones, really. The current ratio, the quick or acid test ratio, which is very similar to current. Our turnovers, both in sales on account and purchases on account, are contained in the last two ratios. So let's start with our current ratio. Very simple computation. We're only looking at our current assets, current liabilities. And they are short-term, right? 1 year or less. That's the definition of current, right? Convert into cash, convert or use cash within 1 year. So their computation or example for current ratio if I get to there is example 3, although they want us to do the quick ratio at the same time. But they throw out a number here that I wanted to mention. So they talk about within 1 year short term, but many creditors use the rule of thumb that a 2.0 current ratio is pretty standard in most industries. 2 is pretty small in my book. I'd rather see 3 or 4. But again, if I get too high, I'm sitting on too much cash. And that's also not a good idea. You want to use your cash for operations that you gotta have covered. And then if you do have excess cash, you should be reinvesting that money into your operation. You shouldn't be holding on to it. So something to keep in mind as we go through these ratios. The other ratio that they talk about in this section is the quick or acid test ratio. This is on page 848. A much more stringent measure. And what's excluded in the quick ratio are non-liquid current assets such as inventories or prepaid expenses are excluded. So it's even more of a liquidity measurement. And if you look at the three current assets that they do select, number one is cash, two is marketable securities or investment in such. Again, short term, obviously. And then finally, number three is our accounts receivable. So those are the only three current assets part of the quick ratio. So be careful when doing this ratio. Make sure that there's only three of these selected. All right, just a little definition. Here's example 3. Companies has current assets of 120. Of these, 15 is cash, 30 is receivables, remainder is inventory. Current liabilities is 50,000. So to do the current ratio, it's simply 120 over our current liabilities of 50. And what does that give us? 2 something, I think. 2.1. 2.4? Oh, I was way off. And then our quick ratio, we have to take out of our current assets the, actually, we just need to add up the 2, right? There's no marketable security here, so we got 15 and 30 is 45. So 45 divided by 50, that's 0.9. So basically, what does 0.9 mean? I've got 90 cents to pay $1 worth of debt, right? Current debt. Or if I look at the 2.4, I have $2.4 of assets for every $1 of liability. So again, the author thinks this is pretty good, pretty safe, right? I'm in a good financial cash liquidity position, but that varies based on industry. I'm not sure if it talked about the current ratio for Apple. When you've got, Apple had 1.11 for every 1. So Apple was here. So their current ratio is only 1.1, basically. Very small. So they are using their cash, lots of cash, for reinvestment. That's where a lot of their money goes, is reinvesting into the operation, R&D, research and development, because it's always the next best, greatest thing in that type of industry. Many small companies could not live on 1.1. That's for sure. Okay, our next one is our, let's see if we did them right. Looks like we did. Oh, let's try one. Let's do problem 41 before we get carried away. 41 has a small section of our balance sheet. We're going to do both here. both the current ratio and the asset test ratio, also known as the quick ratio. Current assets, 29,340,000. Current liabilities, 16,300,000. So they almost have it in our form already. Just put our numbers in. We're going to divide. That's what a ratio is. Divide one number over another. Oh, I forgot the 40,000. 340. What's the 16 million?
600.
Sandy, what's my current ratio then? Sandy at home? .8. Guys, is she okay? Look good? So what does that mean? For every dollar of liabilities, I got $1.8 of assets. Pretty good ratio. Pretty close to that 2 standard. We then look at our 3, right? Cash, marketable securities, and accounts receivable. Well, we don't have marketable securities, so we just grab the cash and accounts receivable. My bottom number stays the same at 16,300,000. And what's my top number, guys? $21,190,000. That look good? Allison, what's my ratio here? A lot of numbers to type in, isn't it? 1.3, awesome. So for every dollar of liabilities, I have, again, $1.3 in current assets, cash, and accounts receivable. So is that a good mark? Again, by itself, it doesn't mean a lot. Remember, they talk about trends. Is this an upward trend? Was last year number 1.2, 1.1, and this year it's 1.3? Well, that's a good thing. So the larger the number, the better. Our cash reserves are adequate to meet our current obligations, so that's always a good thing. Okay. Let's just start this before we take our break. Accounts receivable turnover ratio is on page 848. $849. What's the reason for this? We want to investigate how long it takes to take our receivables and turn them into cash. This ratio is normally in terms of days. How long in days does it take to get our receivables paid? Normally, our terms for our invoices are net 30, right? Which means I should be getting my money within that 30-day requirement. How are we doing compared to that 30-day amount? So the computation really takes on 2 steps. We got to come up with a ratio first. So this is step one. Now, if you look at the other handout, this is in your handout, that separate sheet that I gave to everyone. If you look at that sheet under liquidity ratios on page 1, you'll see this accounts receivable turnover ratio, which is net sales dollars over the average accounts receivable. How do we get the average? There's another computation on our summary sheet. We take our beginning receivables, January 1st. We add our December 31st, assuming a calendar year receivable number, and divide by 2 to get an average throughout the year. This average is our denominator. That's step one. What is that ratio? Once we have the ratio then, you got to convert it into days. So we take that, this is wrong, cross that out. We take step one's answer, our ratio, turnover ratio, that's what should be here. And we divide that into 365. That converts it into days. This is step 2 number. That's what we're looking for. So how does that look compared to 30 days? Is it more than 30 days, if that's our terms, or is it less than 30? How quickly do we have our customers pay us? Example 4 is our example for this particular ratio on page 849. And they do both steps. You come up with this rate. Basically, we got 3 computations. So here's the ratio and the average, that's step 1. And then step 2 is converting into days. So we got to look at an average, right? Average receivables. Once we have the average, we divide that into sales. What's our sale number here? 750. And they get a ratio of 7.5. So how how many days is that? You will always use 365 for the days, and we get 48.7 days. So again, if 30 is our terms and we're collecting on average in 48 days, that's got to be improved if you can. So if we reduce these days, we get our cash sooner. That's the goal here, is to reduce the number of days outstanding. Get it closer to 30. That's what we're looking for. All right, let's stop here. Let's take our... With problem 43, we're looking at our turnover ratio. The problem's on 880. Looking at receivables, right? How quickly can we convert these receivables to cash? Here's our formulas. Really, I think we'll start here. Compute our average accounts receivable. Here we're given January 1st at 5 million, ending 7, divide by 2. So I'm just going to put that computation right on top here. If you wanted to, you could actually create an Excel template, just like the one I gave you on paper. You could just plug your numbers in and it would compute the ratio or the average or whatever formula that you want to compute. Keep that in mind. Use your Excel skills. So 6 million is our bottom number. We're going to divide that into our net sales, 54 million. Obviously, that's what number? 54 divided by 6 is? Eric?
54 divided by 6, you said?
Yeah.
That's 9.
9. So if I sell something on credit, right, it takes a turn of 9 times per year. How does that convert to days? So now we're at step 2. So we went here, step 2. This was step 1. Get that ratio. Step 2 is to convert it into days. 365 divided by 9 is 4 something, 40?
40.5.
40.5?
Wrong with 40.6.
40.6 days. Not too bad. If our terms are 30, we could do better, right? That would be the goal here. But not bad ratio. Most companies are in that 50 to 60 range, especially a smaller company are in that range. Smaller companies have a harder time collecting their money than bigger companies. Again, has to deal with leverage. Any question on our turnover ratio? Again, hopefully this should be somewhat of a review. All right. Let's look at our next ratio. Inventory. So now we're looking at how quickly we pay for our purchases on account. Very similar to our receivable end. We're looking to take our cost of goods sold, not sales. So this is new compared to accounts receivable. We're looking at our cost of sale dollars and now divided by our average inventory cost. Here again, how do we get our average? We take our beginning inventory plus our ending, divide by 2. That'll give us the ratio, and then we again convert that into days by dividing it into 365. So here again, 30 is the norm. Our terms are usually 30 to our vendors, 30 days. We get to pay it back. So any number close to 30 is pretty good. Example 5 on page 851 is where I'm at now. Page 851 shows the inventory turn and then also the days in inventory, turnover days for inventory. So now we're looking at 83 and 87. Obviously, the average is 85. And dividing that into our cost of goods sold, which in this case is 400. So 400,000 divided by 85,000 gives me, what's my answer? It's 4.7, which roughly adds up to 77 days. So I'm just going back here, 4.77 times per year that we turn over inventory. So we convert that to days, and that converts our inventory, how long we hold inventory, in inventory, 77 days on average. Here again, depends on the type of industry. Grocery stores, probably 77 days in inventory would be too long, right, for spoilage purposes. But other industries, this might be just fine. Depends on how quickly you sell your inventory. I thought with Apple, they were around 62.8. So we were at 4.7 turns. Apple was at 62.8 times a year. And that's roughly every 5 days an iPhone flies off the shelf, right? So huge, quick turnover on those Apple sales. So it varies wildly by industry. So the bigger the number, obviously, the 77 days is really kind of slow. So you want, this was turns. That's 5 days would be better than 77, obviously. So let's try 46 as our example for inventory turns. Rather large numbers, so bear with us. I don't know why they have to get so, oh, I was looking at 45. We're okay. 46, calculate the average inventory first. So we're going to start here again. Average inventory is, let's see, beginning inventory was 53,420. Ending inventory was 62,640. We take those and divide by 2. Can someone help me with that number? Sydney? Sydney, are you home? Allison, how about you? Can you help me with this number? What's my average here? $298,480. I'm just looking for the average inventory. It should be around 57,000. All I'm doing is I'm taking the 53,000 plus 62,640 is 58. Awesome. 58,030. That sounds better. That's our bottom number then. I think, right? Or somebody coming up with a different answer. Oh, okay, no problem. Our cost of goods sold is 1,859,000. What's the last number? What's my cost of sales here? Olivia. Problem 46.
says it's a gross margin.
Oh, shoot, you're right. So I can't even use that number. Oh, no, I messed up that number. All right. So how do I get my cost of goods sold? That number's good. We gotta take our sales, right? We gotta subtract our gross margin. They're just trying to make it tougher on us. Gives us our cost of goods sold, right? So I've had 3,948,000. $340, yeah. And if I subtract my gross margin, 1,859,260. Can someone help me with that number? I know this is 80.
1,089,000. 6,089.
2,089,000. Like that?
Yeah.
There you go. Thank you. $2,089,080 is our cost of goods sold. So let's jump that up here. That's a lot of turns. How many turns is that?
36.
36 times in a year? Does that come out exactly 36? So there's 12 months, so every 3 times in a month, right? So every 10 days. So our turnover in days should be around 10. So if I take 365, divide it by 36 times, right? It's 10 point, is it even 1?
It's 10.138.
If I go to 2, oh, that's not a percent, it's days. Sorry. Get carried away with percent symbols. So every 10 days, I'm turning my inventory. So the larger the number, the better. If I can turn my inventory quickly, that means I don't have that cost tied up in inventory, right? It's getting sold, and I'm making money on every product I sell. If you look at my notes for these ratios, off to the right-hand side of these notes, I explain whether the number should be growing or larger, or should the number be smaller, which is better, right? Which is going to give us our better operation when our numbers are growing or when our numbers are reducing. What makes this ratio so important to look at? So look to these to get an understanding how the ratio is used. How is it used? What does it look like? Like number of days, turnover days, provides how long it takes days to sell a company's inventory. The lower the number of days, the better. Oh, yeah, that makes sense. That's just what we went through. All right, so hopefully that'll help. Let's just try, I think, one more problem here. Do I have one more? We'll just, problem 61 is a summary of all the ones we've done. And let's just do, maybe what I'll do here, rather than go through these, I think you have an understanding of these, you should. I'll just put the answer key for 61 out there. You actually won't do this one. All right. What do we got next? Leverage ratios are next. Leverage ratios begin on page 853. There are three of them under the leverage ratios: times interest earned, debt ratio, debt to equity ratio. And basically it shows us how risky they are as far as their ability to pay long-term debt, right? Carry long-term debt, as it shows here. So we'll start with the times interest earned. It's an unusual ratio. They're looking at income before taxes plus the interest expense divided by the interest expense. So like my notes say, the larger the number, the better. I have a better ability to take on more debt if I need to. I have the ability to pay back the bank if I have to take out more debt from the bank. So the larger the number, the better. The example is 6 in this case. We're looking at the income before taxes right here. Here's my interest expense. So those two numbers are what we're going to use for this times interest earned. So 265 plus 15 is 280. Divided by 15 is 18.7 times. Here again, the larger the number, the better. By itself, 18.7 means nothing. It's when we compare it to other years or maybe other industries that it's worth an analysis, right? So the other one that is used is our debt ratio. Very easy, total liabilities over total assets. And what does this measure? This is on page 854. Here's the smaller number is better, right? The smaller the number. If I have less debt to my assets, I have less risk. I'm more able to take on more debt if I need to. So the smaller the number of this ratio number, the better. And the example here for this is going to be example 7. Because also on page 854, they talk about the debt to equity ratio. And that is total liabilities over equity, right? Stockholders' equity. So how much is financed by debt to purchase assets, and how much of it is coming from our stockholders' equity in the form of stock, sale of stock. Obviously, if we're a stockholder, we want this number high. If we're a bank, we want this number low. So it depends on who you are as to whether this ratio should be bigger or smaller. But again, it's another assessment of risk as well. So Example 7 then shows us those computations. Example 7 is on page 855. Very simple computations, not difficult at all. Our debt ratio is 60%. Not too bad. Um, Anything approaching 100% though is more risk, right? So we have to be careful with this number. And then our debt to equity ratio means that for every dollar of equity from our stockholders, we have $1.5 from our banks financing our assets. So is that a good number? Again, depends on who you are. If you're a bank, it might not be so good. If you're a stockholder, it might be just perfect. More of the debt is on the bank rather than the stockholders. So let's try problem 50. We'll try these, see how it goes. Again, they're pretty straightforward. Juro Company has their income statement up above. They have some liability and assets information below the income statement. So let's do our times interest earned computation first. I already have the formulas there. We're starting with 2.1, oh, excuse me, wrong number. We want income before taxes. We're taking 3.5 million of net income before taxes plus our interest expense, which is 1 million. And we're going to divide by 1 million. $4.5 over 1 is 4.5, right? 4.5 times. Again, larger would be better. So if last year it was 5 or 6 and now we're at 4.5, that's not a good trend, right? We want to make this number bigger, not smaller. Our debt ratio is total liabilities, 10.25 million over 16.4 million of assets. That's about 60%, right? Can someone help me there?
Okay.
62.5. And that's a percent. So for every dollar of assets that we own, 62 cents was financed by debt or banker's notes, bank debt. And then finally, our debt to equity is our 10,250,000. I'm going to put that down here. I'm going to change colors now. I didn't change colors. 10,250,000. And I'm going to divide by 6,150,000. Carla, what do we have for a ratio there?
1.6 repeating.
Let's just go 1.6. Now, this ratio can be shown as a decimal or as a percent. I'm just curious as to what we're gonna want. It just has it as a decimal, debt to equity. So for every dollar of equity, I have $1.67 of liabilities or debt. So if you're a shareholder, that might be good. If you're the bank, maybe not so good. And obviously, we would look for trends as well. Uh, 57 is another one of these. I don't think we have to go through this. What I'll look for is just an answer key. So for 57, you can do that on your own if you'd like. And you can review on your own, I guess. And there's other problems in the assignments that will allow you to do that. 62 is another one. Again, we'll just review that on your own. All right. I want to go about 5 more minutes yet. Let's just get started with some of the profitability ones. And then we'll end with those on Thursday. Carla, just so you know, I will open up the exam also on Thursday. So you can take it anytime between now and Tuesday of next week, the 14th. All right, so for our profitability ratios, we're beginning on page 856. Looking at these, investors want this for their analysis, right? Whether they should invest in a company. It's also used to help set the market price, right, of stock for many of those companies. So that's what it's talking about here. Looking at profitability ratios, the big one is return on sales. Huge ratio, normally shown as a percent. This is also done on our vertical analysis. For our income statement, because the base is basically sales, how many cents on every dollar is made? So looking at this, we're looking at return on sales, or we're making 4.6 cents on every dollar in this particular case. Good ratio, especially if you have a lot of sales. Example 8 is our exercise example. This is on page 856 as well. Shows the 4.6 cents to every dollar of sales is earned. That's the profit on every dollar of sales. So that's an easy one to do. Return on assets. This is probably your more complicated one because of the top number. So what this is trying to measure is how much money are we making on our assets. So profit on asset investment. So if I bought a piece of equipment, am I making enough dollars on that investment? How good am I doing on that particular item? Here again, we divide by average total assets. So again, we add the beginning total assets to the ending, and we divide by 2 to get that average. But what makes this complicated is we have to take the finance portion out of our expenses. So I'm adding that back into our net income. But there is a separate computation, net of tax effect. So if my tax rate is 40%, I'm taking 60% then of my interest expense to get the effects of that finance away from our analysis here. So I'm reversing that basically on our particular problem. So here again, they show that after-tax effect. They compute that on problem 9, and that just shows you on problem 9, we're looking at that example on page 857. So now I'm on 857. The result was basically I'm making 8% on my investment. Page 857, I'm making 8% on my investment. Good average. Brianna, you can just have a seat. I'll be right with you. Okay, so let's take a look at this with example 51 and 52. And this is where we'll end today. So let's turn our page back to 853. The numbers are on 852, or 882, I'm sorry. 882. Calculate the return on sales. Very simple. We take our 2,100,000. We divide by our sales, 11.3 million. How much money are we making on our sales? What's our ratio here? Allison, are you still with us? Oh, you answered the last one. How about Sandy? Sandy, can you take this one? What's my return on sales? What am I doing here? 2.1 divided by 11.3. Oops, that didn't work. 2.1 divided by 11.3. I got 18 cents. Not 1.8. Yes, Allison, 18.6% would be correct. 18.6. So as a decimal, it looks like this. 0.186. As a percent, 18.6% is our answer. So for every dollar of sales, right, I'm making 18 cents on it. So pretty good. Apples was 23 cents on every dollar. So very good return. Looking at our assets, we don't have to average because they only gave us 1 year's of assets, which is 16.4 million. So that's my bottom number. My net income was 2,100,000. My interest expense was how much, guys?
1 million.
1 million? But what's my corporate tax rate? I have to multiply this by something. Is it on 52? Yes. What is the tax rate?
40%.
40%. But I have to multiply it by the complement, 0.6. So 1 minus the corporate tax rate, 1 minus 40% is equal to the 60.6 here, right? So I'm going to add 600,000 to my amount. That's going to be 2.7 million. And I'm going to divide that by 16,400,000 of assets. And Carla, what do I get now?
Is it a decimal or a percent?
You can give it to me as a decimal, but most likely it'll be a percent.
Then 16.5%.
16.5. My board just went dead. Looks like it's time to quit, guys. Oh, that's so terrible. What did you say, Carl?
16.5%.
I gotta hit the right button here. That's freaky, isn't it? Whoa, 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 whoa. Come back. Stop, stop. My board's going crazy, guys. All this technology. Does that look okay, guys? 16.5, everybody get that? Stuck it on the end. I gotta save what I got because I don't want to lose it. Is everybody comfortable with why I didn't have to average the total assets? Because we only gave us one number. They didn't give us 2 years to do. So the average is automatically 16.4. So what is the result here? My board is dead. That means for every dollar of investment in my assets, what? I'm making 16 cents. Pretty cool. The market's making, not today, it dropped quite a bit, but normally the market tries to generate between 7 and 10% annually. Here we're making 16. So that makes me feel good. I'm making more in my investment here than I would in a market or somewhere else. So that's the goal here, is to look at that percentage. Okay. The rest then, for chapter 15, we'll talk about on Thursday. I'm looking at about an hour on Thursday, maybe an hour and a half. If you wish to collaborate rather than drive in, it's supposed to be cold, wet, and rainy. You may do so, or come and join me if you'd like. If you wanted to, after class, you could actually take your test already for that chapter if you're comfortable and you have your homework done. You could certainly do it at that point. Guys at home, are you okay? That sound good? All right, thank you, Allison, Sandy, Sydney. Awesome, thank you. Guys, have a great day. Enjoy the weather while you can.